So, ladies and gentlemen, welcome back. I hope you enjoyed your lunch on this lovely sunny day. Now that we know the world is all hunky-dory, as we heard from our expert panel before lunch, what about the trend of banks merging, downsizing, the change in capital markets, and the shackle of regulation? Well, I'm pleased to say we have an equally expert panel to talk about the future of banking, not surprisingly, made up of bankers. Let me introduce the panel. Our panel chairperson today is Lobun Chai. As Euromoney called him one of Asia's best-known bankers, he's recently been lured away, so I hear, from Deutsche Bank to join Bank of America Merrill Lynch. Our panel moderator today, David Clark, who's the honorary president of the ACI and veteran banker, working in currency and capital markets for some of the world's biggest banks. John Cryan, president of Temasek Holdings Europe and former CFO for UBS. Piyush Gupta, CEO of DBS Group, who also worked with Citibank of head of ASEAN markets earlier in his career. Antonio Horta Osorio, Group Chief Executive of Lloyds Banking Group, and also Robert Morris, Chairman and Chief Executive of Barclays Asia Pacific. Definitely a power group of bankers. Gentlemen.
A very good afternoon, ladies and gentlemen, and a very warm welcome to session 2 of this Congress entitled The Future of Banking. As fellow panelist Piyush Gupta mentioned just before we came in, I probably have the easiest role of this panel. Well, I'm called the chairman of the panel. The work is really being done by all the 5 eminent panelists that you see in front of you. However, to get our money's worth, and to make sure that this is relevant for you, together with the organizing committee, myself and David, I hope we have put up some of the most difficult questions as background for the panelists. If you feel that there's not sufficient, there'll be mics that you can use to raise questions. Doesn't necessarily need to be at the end of the session, could be in the middle of this. And this session comes at the most relevant and interesting time for us because more than any other global sector, the industry has undergone and still undergoing profound change over the last 6 years. While the impact in Asia Pacific may have been felt lighter than in Europe or the US, we're still working through unresolved issues which stem from the need to rebuild trust in the global banking system. Some of the examples are money laundering, too big to fail, living wills, Volcker rule, derivatives reporting, banker bonus cap. The list could go on, but clearly it reflects the thinking in the industry and by various stakeholders today. The issues are numerous, global and complex, and will be continuing to be shaped privately and publicly through a combination of market forces, regulators, international committees, politicians, blocs, and media headlines. So the discussion today will focus on the future of banking and the new paradigm of banks, and I look forward to a panel of experts to provide us with insight and some lively debate on how they see this industry evolving over the medium and longer term. I'm indeed honored and glad, and I'd like to thank the panelists for taking this up. I think there are no other panel or panelists that could do the job better than what we have in front of us this afternoon. Just for your orientation, to your left, we have Robert Morris, Chairman and CEO of Barclays in Asia Pacific, followed by John Cryan, President of Europe and co-head of Portfolio and Strategy Group at Temasek Holdings. And no introduction, in the middle there we have Piyush Gupta, CEO of DBS Bank. And then we have Antonio Horta Osorio, the Group Chief Executive at Lloyds Banking Group. And I'm also very privileged to have David Clark right at the end of the role, who has an esteemed 43 years in banking and too many accolades to mention, both in the non-profit and for-profit arena. David is also a former president of ACI and the honorary president of both ACI and ACI UK. So with that, my role is done, probably quite easy as Piyush said, and I hand over to David and the rest of the panel. Thank you.
Boon Chye, thank you very much indeed for the introductions to all of us, and to you and ACI Singapore for asking me to moderate this panel, which has quite the most enormous title, The Future of Banking. In fact, it's arguable whether we would have had a panel like this even 5 years ago. If it was 10 years ago, we would have been celebrating banking. 5 years ago, for those of you who, if you cast your memories back, it was exactly the time that Bear Stearns reminded us that there was a bigger problem than we thought we had. But what we have to ask ourselves is, how do we get here in the first place? It was good this morning to hear so much laughter on the first panel. I don't think that the future of banking is going to be quite so hilarious in terms of its comparison with our discussions on the foreign exchange market this morning. And it's worth looking back to say what caused it in the first place. Very often when I'm listening to US and European, in particular, regulators, I sometimes think they have a false analysis of what happened. Was it about macroeconomic global imbalances, in fact? We've had twin deficits since the 1960s. We had an over-borrowed developed world, and in some people's opinion, an over-saved developing world. Was it about credit derivatives? Credit derivatives were an unimaginable hedging tool for us in the mid-90s in terms of hedging credit. We were never before in a position to short credit. Suddenly we could do it. But they transmogrified themselves into CDOs, CDO squareds, and things that people to this day still are trying to unravel because they don't understand what they did. Was it actually a little bit about the property bubble? Property is a particularly unique and problematic asset class, or is it just part of subprime? Was it about financial regulation? Were the regulators really empowered? Could the FSA in 2005 have marched into RBS and said, well, I don't think you should be buying another bank? Of course they couldn't. Do they have the skill sets? Did they, in some cases, look the other way? Was it about bad bank management? In some cases, conspicuously yes, and in some, conspicuously no. What about risk management techniques? Close to the heart of all of you here. We had never before had such skills in risk management, right when the crisis broke out. But we became obsessed with measures like value at risk, and we didn't even question how valuable they were and how we should use them, because we didn't use the smell test any longer. Or was it about all of the above? Was there something of this which is a little bit like a perfect storm? But whatever happened, happened. And then we had the backlash, which we're still suffering from and bleeding from. We were blamed for everything, absolutely everything. We were seen as the masters of the universe. Lord Turner, then chairman of the FSA, said that we were producing socially useless products. And as Boon Chye alluded to in his introductory remarks, the bonus culture has caught up with us. It was about money. We had it too good for too long, but in the mid-noughties, both George Bush and the IMF went out of their way to say that the contribution made by financial markets to households and to recycling was a very sound one. That was their verdict on innovation. And of course, the benchmark event was the G20 meeting in Pittsburgh in 2009, which is very often quoted as a justification for some of the regulations that regulators are trying to impose on us. They did use those famous words where appropriate, but they got lost. The US drifted off in the direction of Dodd-Frank, partly, mainly perhaps because of AIG, Freddie and Fannie, which we didn't have in Europe and which certainly didn't occur over here in Asia. The EU drifted off in the direction of MiFID and EMIR, which started off as being something about protecting consumers and now is about regime change in the market. And on top of that, we have extraterritoriality, We are, in short, swimming in unintended consequences. So, where are we going to go? What do we really need to fix the banking system? And this is why I'm so pleased to be joined by the panelists who we have, because day by day they are steering us towards a better and safer banking environment. But is it about capital and liquidity? Basel II was seen as too complex. Perhaps it was. It certainly wasn't implemented evenly around the world. But Basel III doesn't look a lot less complex to me than Basel II. Is it about market infrastructure? Or should that be left to the private sector, to people sitting out there, to the banks, the brokers, the platform providers, other vendors, to actually maximize the ability that we have to produce the right infrastructure? Should the banks be split up? And is there a difference between supervision and regulation? I don't mind being supervised. I don't think I like being regulated. Banks have also done very differently in different parts of the world. And very often this looks like an issue that is principally US and EU driven, and driven out of a very worn banking culture. What should the system look like in emerging and growth markets? And I think for that we can say Asia. Because I think there is a good fortune that they can look at what's going on in the US and Europe and say, well, we're not doing it that way. And what about the role of the near banks, the shadow banks, perhaps some of the fears? These are the questions. I certainly don't have all the answers, but hopefully in a little under an hour and a half's time, we'll have a number of them. I'd like to start off, Piyush, if I may, with you, because I think you're playing a home game here. And what I'd really like to get a sense of is your view as the CEO of DBS. How do you respond to capital and liquidity? Have Basel got this right? Are the supervisors on the right track with this? Or do you think that there's some errors in the way that they're approaching it?
Well, actually, can you hear me? Is the mic on? Hello? Is the mic on? All right. Okay, I'm going to first start off by actually reflecting on something Bunchai just said. I finally figured this whole issue. All my life, I figured I should have been a trader instead of being a commercial banker. Because to me, this is best proof of the point. You come in late, you go early, and you get paid the most amount of money, Bunchai. I think this is a brilliant way to be. All right, David, I think, fundamentally, the notion that a lot of the failures 5 years ago happened because there's too much leverage in the system, there was not enough liquidity, or there were too many gaps, liquidity sourcing as well as gaps, that capital was inadequate, where people thought they had capital, it was not available to take risk assets. And quite clearly, you can't debate that. I think that's a truism. Therefore, to do stuff to make sure there is more capital, sound and liquidity is undoubtedly appropriate. To my mind, the questions to ask, though, are really around how much and how. So you take the how much. I think it's quite clear that, you had a point on your slide. The fact that banks play a very useful role in bringing the real economy, the global economy forward. That's why banks were formed. So intermediating across time, intermediating across risk spectrums, these are all useful things that banks do. And therefore, as you think about how much security and safety you want to build into the banking architecture, you have to trade it off against how much does it impede the creative role of banks in the improvement and furtherance of economies and societies. And in that context, it just seems to me that the current pace of regulatory focus on both capital and liquidity might be getting overdone. As you pointed out, we in Asia learned a lot of lessons after the 97-98 crisis in Asia. And it's no coincidence that for the better part of a decade after that, all of Asian banks have had high levels of capital, We've had very tight regulation, but 10% north capital adequacy ratios have not been uncommon. Now, when you start with that base, and then you run into a regulatory regime which expects you to do even more, and you run into a marketplace circumstance that expects you to gild the lily even more, then you start wondering whether the how much is getting to be over the top, and in the long term will wind up with unintended consequences of creating an issue in terms of the role of banks. This gets even more complex because not only do you have a global agenda, Basel, BIS, FCBS around capital, you have individual countries who are then trying to superimpose, on top of that. And that's obviously a substantial challenge for the banking system. In my view, relying purely on incremental capital and liquidity, the rules around liquidity in some ways are even more challenging and onerous than the capital requirements. These are blunt instruments beyond a point in time. So I think getting the system to some level is an appropriate measure. Using these blunt instruments to take them to the nth degree is kind of risky in my view for the banking system. That's the how much. If you think about the how, I think it gets even more complex. I think the plethora of rules around Basel III, both the consequences and aspects of modeling, of using normal distributions, of the plethora of regulation around liquidity, infrastructure regulation, I think we are binding ourselves up in knots. And at some point in time, we're going to have to think about a more effective and practical way to let the system correct without actually trying to put a huge amount of challenges which might be counterproductive.
Mm-hmm. Antonio, the point on capital, it may have been overdone in some respects, perhaps Piyush is implying, but have we moved out of a regime which simply didn't put enough emphasis on capital, and perhaps the wrong type of capital, the upper tier 2 and the other types of capital and the hybrid capital didn't help us? Is that, how big a role has that played in your restructuring at Lloyd's?
Right. Do you hear me?
I think it comes on the
screen.
Yeah?
Okay, good. Well, I fully agree with what Piyush says, and I would like to add the following points. I think it is clear that society needs safer banks and more boring banks. And therefore, what is critical is how to balance financial stability on one hand with growth and support to the economy on the other hand. And when you look at it that way, financial stability itself can be seen as a combination, as you were saying, of stricter capital rules, stricter liquidity rules, but I think it is also a combination of recovery and resolution mechanisms and of more intrusive supervision. And that's why, for example, I have publicly supported the ring fencing of the UK banks, because I think that ring fencing allows ex ante for easier recovery and resolution mechanisms, given it separates ex ante investment banks from retail banks, and therefore it avoids banks requiring more capital than otherwise would be required. So I think we should see financial stability as a holistic combination of these 4 pillars, and depending how the 4 pillars adapt in each of the countries where we are present, you can have different combinations. For example, in the UK, given that the UK economy has more credits than deposits, has a loan-to-deposit ratio substantially above 1, I think the liquidity requirements should not be as strict, and it is better to rely on ring fencing, recovery and resolution, supervision and capital, where the UK banks, in my opinion, have significantly better metrics than elsewhere, especially in Europe. So the question is now, if you see it that way, how do you then set the proper combination of these 4 pillars in order not to damage economic recovery and support to the economy? In the specific case of the UK, I think the country is going now in a better direction, because in the summer, the UK authorities decided to relax liquidity rules, big change, and they have decided to implement the funding for lending scheme, whereby they lend more to banks at a cheaper rate the more we lend to the real economy. And those, in my view, were the two most important policy changes we saw in the UK last year, and in the right direction in order to balance financial stability and support to the UK economy.
Yeah. Before I go on to Robert, just to pick you up on that, if I may, Antonio, to what extent was the relaxation a function of a conscious decision by the bank and the British government to try and stimulate the UK economy? And to what extent was it because, do you think, Basel had second thoughts about the liquidity coverage ratio and the net stable funding requirement, that they might perhaps be too tough, or that they were getting too many criticisms?
I think it was more of the former, because the FSA's position at the time was that even if Basel would be delayed, they would be setting out their own rules.
Yep.
And I think what happened is that in this holistic solution, they thought that the UK economy was double dipping, as it was. There was significant concern about the Eurozone, given all the turmoil in the summer in the Eurozone. And so I think it was clearly driven by a better balance between financial stability and supporting credit and the UK economy.
Yeah, that's very interesting. Robert, you've got a head office sitting in London, and here you are responsible for Asia Pacific. Does that give you a good feeling, by the way, in terms of the fact that you're not at head office at the moment? And how do the dynamics work, thinking about liquidity and capital for your businesses out here? How integrated can you manage that with a head office sitting in Canary Wharf?
Yes, I think, well, there's a couple of things. Firstly, it's a much happier place to be out here than it is sitting in London when I go back, and that's for sure. When you think about all these things, and we do run a globally integrated treasury and how we run the business, but when you think about banking itself, I mean, the fundamental point about banking is trust. And one of the problems we have is in trying to rebuild trust with all the different stakeholders is the lack of clarity still around the future shape of regulation, and I think that's the challenge. Once we have a future shape of regulation, then we can agree on as Pierce was talking about, a phasing almost to avoid unintended consequences of those businesses. And just touching on your last point about the liquidity, I think it's natural with most of these things. We came from one point in the financial sector and we've swung so far back the other way. Hopefully the adaptation of what the liquidity rules are now requiring and what our regulators are encouraging us to adhere to are the first signs that they've realized that some of these issues are really starting to bite into the system. And just to give you an example, I mean, a year ago, Barclays had $220 billion sitting in liquidity. I think we'll probably be down to about 150 by this year and hopefully gradually lower. But it didn't really make that much sense to be sitting on that much liquidity. And the challenge is, until we rebuild that trust overall with all the different stakeholders, it's very hard to get, for the local people in the local economy actually to get any sort of confidence that they actually want to borrow in the first place. I mean, we deal with all the time people saying we're not lending enough as banks, but in reality, a lot of people don't want to borrow. And so we have to rebuild that confidence. Now, when you look at how affects this us in the region, there are a number of trends that we can constantly focus on. Subsidiarization, where the local regulators move to that model, and how that would affect our solus capital, not just our regular capital position. And that's a constant focus on for us because capital becomes trapped, and we can't leverage it across the branch and the branches group globally. So that's a very difficult thing to focus on. And again, liquidity, what you see in liquidity has become, although the requirements are easing in one way, the constant fact that potentially eligible collateral gets downgraded provides less and less collateral to hold against that liquidity, and that can create some unintended consequences as well. So I think there's quite a lot of movement going to be needed from the regulators over the next couple of years as they start to have empirical evidence over the last 2 to 3 years how they can change some of these requirements to make the business work on a more efficient basis and enable us to provide the services at a reasonable price to the end customers.
And John, as a former banker, I mean, you're not exactly a spectator in this particular field of how banks should be risk managed. Basel is being still held as potentially the answer to the problem. It's certainly, along with the FSB and IOSCO, perhaps part of the centre of the power of thinking. Are capital and liquidity that important for the banking sector? Or would you put more emphasis on other methodologies of regulation and supervision?
Well, I think I instinctively take a step back. And before getting into the question of whether capital or liquidity adequacy ratios are satisfactory methods in which to control banks, I think the debate that hasn't satisfactorily been resolved is what the role of banks should be. And I don't think it's until we know what the role of banks should be that we can start to measure whether they're performing that role and to whose satisfaction they're performing it. And there were definitely conflicts of interests when banks were run a decade ago before the crisis as to which of the shareholders should receive what proportion of the value created by banks. And I think there's a general consensus now that too much of the value created went to shareholders and probably staff, and too little went to protecting creditors. But I also go back to not just to the objectives of the management of a bank, but actually what the strategy of the bank should be. And there's a simple legal definition, which is banks take deposits. So that's easy, we can sort of tick that box. But then what they do with the cash that represents those deposits is, I think, where the question starts. And of course, traditionally, banks have been lenders. And I think the fundamental cause of the crisis was poor credit extension. Ultimately, it got re-engineered around the system. But ultimately, a lot of banks and a lot of other institutions, particularly fixed income institutions, which were by and large bailed out as well, made incredibly poor credit decisions. And they did that because they lent to people who couldn't repay, and they didn't fund that lending in a particularly prudent fashion. So they ran big asset liability mismatches. And as a consequence of the credit losses, I think the response was, let's have more capital, instead of let's try not to incur such large credit losses again. And in relation to the asset liability mismatches, they came up with stable funding ratios and liquidity requirements, which to some extent address them, but they don't go to the fundamental problem. So I think symptoms have been managed or sought to be managed using the Basel recommendations, but not the fundamental problem. And the fundamental problem is what banks do with the cash that they hold on trust for other people, and to what extent bank management teams should be free to prosecute other forms of business, whether it be securities trading, derivative trading, insurance, fund management, cash processing, what the ambit of the functions of a bank should be, and whether they should be broken down into individual businesses that are separately managed. And I think that then moves into the debate about whether banks are too big to control, too complex to manage, adequately capitalized, and properly run. Mm-hmm. So I think Basel, I've actually always been a bit of a proponent of Basel. I think when you're managing a balance sheet, it was very difficult in 2008 and 2009 to say that banks would not be better off with more capital. They quite obviously would be. And they had far too little before. Piyush makes quite a good point. Perhaps the pendulum has swung too far. Banks should have been more liquid. They should have had better quality funding, longer term funding. And it's difficult to argue with the fundamental tenets of Basel. The question is, though, what do we do? What do we do as a bank? What is the business model for a bank? Because making banks more liquid and making banks have longer-term liabilities doesn't solve the fundamental problem, I don't think. And I think one of the problems went to management, because management drives strategy. And my sense always was that banks became too entrepreneurial a set of companies. And they lost that balance. When you're running a balance sheet, I certainly felt that I had a huge obligation as a trustee holding money on other people's behalf. And I wasn't always sure a decade ago that that was at front of mind in many of the people who were running banks, because their objectives were different. They ran a bank as though it were a normal operating commercial entity, and they wanted to grow it. They made M&A transactions that were perhaps not so prudent as they could have been. And I think they lost, or at least they resigned the role of trustee to a relatively minor role in the way in which they thought about how to run the bank and what its strategy should be. So I think that needs to be revisited. I think there could be some good work done globally to agree a framework for what it is banks are allowed to do, what they should do, their role in the economy, their role in society. And once that's clearer, then I think it's easier to regulate them and provide some global set of rules that allows banks to operate fairly across jurisdictions and not to arbitrage and continue to manage themselves in a manner that seeks differences in rules and situations to create profits.
Well, as an investor, somebody comes to you and says, tell me why I should buy bank shares. Why are bank shares, when and under what conditions would they be a good buy? Bearing in mind that we have probably the only industry that has not a global regulator, but through Basel, a global accord, which is genuinely global. And at the moment, it doesn't look terribly interesting to buy bank shares in many respects. Having said that, looking at the share price of Lloyds and RBS and Barclays indeed, and others, one doesn't know whether they're back to normal yet, but they're volatile and they've been interesting. But what do you say to an investor to try and persuade him to buy a bank share? What should he expect for his investment?
Well, that goes to a number of other questions, and we don't want to spend all afternoon talking about accounting, but it is genuinely difficult to understand a bank from, notwithstanding the fact that most of the bigger banks produce the thick end of 500 pages worth of information each year. Banks deal in intangible assets, and so you rely on the description of those assets in some financial accounts as the basis on which you judge the company. It's not like, there was an example used of BMW this morning. If BMW makes great cars, it gives you some sense that they're doing something right. And they sell lots of them. You can drive one, you can touch it and feel it, and you know what is produced. With a bank, it's very difficult because everything's so intangible. So you rely very heavily on financial results. And I don't think the accountants have been terribly helpful. There's not a general criticism of accounting, but I think in financial product, the way that there's optionality at the discretion of the filer as to how a particular product is accounted for, and there are 2 to 4 valid representations of exactly the same transaction on a set of IFRS accounts, it starts from a very bad place, and I don't think it gets any better from there on. And so investors need to rebuild confidence in banks. And in the very old days, when I was a young man, I was always told that the only basis on which you should buy shares in banks or insurance companies is to look at the dividend, because you knew when the dividend came out, it was in real cash, and that was the thing you could touch and feel and spend. And a number of banks have not been able to pay dividends, and as a consequence, that analysis has not been available. But I think once banks feel they're better capitalized, once I think there's better regulation of accounting of banks, there's a fairer and more uniform representation of particularly the asset side of the balance sheet, then I think confidence will return on the part of investors, and they will recognize banks for what they are, which is a profit-generating company.
I'd like to move on to resolution and recovery planning, and I'd like to, Antonio, pick up, if I may, with you first on this one, especially bearing in mind a comment that you made in terms of ring fencing. It is probably the only thing that's going to make the too big to fail problem potentially soluble in the long run. But are we putting too much faith in resolution and recovery planning in terms of whether it can be really achieved? Because can global banks really overcome local difficulties in terms of resolution?
Right. Well, That is a very interesting question, which I think has to be seen in two dimensions. The first is the too big to fail problem is not supposed to be tackled by recovery and resolution alone, should be tackled by the financial stability framework, which I just described you in terms of recovery resolution, including ring fencing, and capital rules, liquidity rules, and supervision. I think that is critical. And the second one is we have to tackle it in a systemic way, i.e., the financial stability solution, in my view, has to be set in such a way that the risk of a bank failing will always still exist, because otherwise the probability would have to be so narrow that the burden for society would have to be too big. So there will always be the risk that a bank will fail, but it then should fail in an orderly way, but the system should be protected to a very high probability. And in terms of recovery and resolution, specifically, I think you have two perspectives as well. The first is, for example, ring fencing, and you could say Volcker, or you could say in the future Liikanen, which is similar as well, which is you should, in my view, upfront, ex ante, you should separate retail banking from investment banking, which makes it simpler should a problem occur, for example, in the investment bank, in terms of contamination of the retail bank, which is the logic that Vickers is following. And then you have the second level analysis, which is what should you then be able to protect in case a bank is going to fail? And those are the critical functions of the economy. So a retail bank will also be able to fail, but you have to be able to either take these functions out and sell them to another bank. So the deposits, the payment system, you have to be able to take them out and sell it to another bank, or the regulator has to ensure that they can continue to function in an orderly way. And the recovery and resolution mechanisms, as they are now being developed, are exactly being developed along these lines. So how can you protect current accounts? What do you do with the money that people are transferring overnight that can be caught by accident in another bank? How can you make sure that this is solved in an orderly way? And I think this is not an easy question. The ideal, in my view, is to really set the rules of financial stability at a level where you don't create panic, but you now have to go deeper into recovery and resolution in such a way that when a bank will fail in the future, and I really think that this should be allowable, because banks, like companies in any other sector, should be subject to capitalism and to the possibility of not being useful anymore and have to be unwinded, but they have to be unwinded in an orderly way that fully protects customers' deposits.
Yeah, but Piyush, as you gather from what Antonio has said, there's a massive amount of thought certainly going into this. I know particularly through the FSA, the Bank of England, the PRA, and in Europe. Is it such a hot topic out here? I don't have a feel for where the views are on recovery and resolution planning in Asia. And I'd like to pass that on to Robert for his comment on afterwards.
Let me first go back to the basic issue. I am at polar opposites from where Antonio is on the whole issue of ring fencing. I think
I was going to come on to ring fencing in a moment, actually.
Right.
But please
goes
do
back
now.
to the resolution
in that case,
issue,
carry on.
Right? Because I think the whole notion of being able to create ring-fenced entities, whether ring-fenced in a geography sense or by business lines, is actually quite simplistic. And it places an enormous burden on the banking system, which goes back to the issue we had before about growth versus stability. Just anecdotally, like Lloyd's, but we have a large retail and consumer balance sheet in Singapore. Singapore's a savings surplus country, and our savings rate is 40% or high 40s. Our investment rate is mid-20s. So there is a lot of surplus savings in the country. We have 55% market share of savings in DBS. We collect all of the savings. The notion that we can run an efficient bank by taking all the savings and putting them only into a consumer retail marketplace without actually using the surpluses in other parts of the region and in other opportunities is a non-viable notion. So by definition, we have to run a broader, more universal agenda where we take the surpluses and use various markets, including fixed income markets, to intermediate across countries and across risk types. And therefore, to me, if you ring fence and say this is not a good thing to do, we just want to block this, and A, it's not practical, and B, it doesn't let you actually run an efficient institution. So to your point, who would put money and capital in a bank? So next step, if this is not so easy, to my mind, the notion of getting the resolution frameworks right becomes even more important, right? So it's even more tricky because you can't really ring fence effectively. The big problem around resolution today is really lack, particularly for the global banks, and we're seeing it in the region, is really, I call it lack of trust among the regulators and lack of trust among government agencies. And so, because the government and regulators are unable to come to terms, including getting a common legal framework and a set of rules and processes. So, since you can't get that done, it's quite simple to say, let's ring fence. And that's where we're getting down to. So, foreign business office in the US, ring fencing, whether it's Vickers or Likkonen, etc., are all shortcuts because we're not able to address the fundamental issue of driving an architecture and a trust mechanism to allow resolution in a better way. I think in your specific question, I think Asia has been relatively behind the curve. I think some ways it's because we did not go through the same pain as the West did. But in recent times, it's quite clear Asian regulators are beginning to apply themselves to the issue as well. My personal engagement with the regulators continues to boil down to the need to make home host supervision mechanisms tighter, to make cross-country regulatory mechanisms tighter, because that's the best way to get a resolution mechanism which is efficient without creating inefficient ring fencing.
Well, then how are we going to get agreement on global resolution and recovery? That is a question that worries me intensely. I mean, I hear exactly what you say, and I have to agree with Piyush's comments on your comments about ring fencing, but perhaps we can come in a moment. But if I think about, for example, Barclays amongst others, how likely is it that the US would want to play ball, for example, on a global recovery and resolution plan? And which should be the entities that are pushing the banks? Is it going to be your home regulator? What rights and roles has the host regulator got? Can you have a European recovery and resolution mechanism without having a global one? Antonio, first in that.
I think this is a very interesting debate. And I fully agree with Piyush on everything he said. I think it's worse for banks to have ring fencing. It is costly. But I think that's exactly why the regulators don't want banks to do this, because regulators do not want banks to use the deposits of the people in the countries in risky activities, and then they have to foot the bill when there is a problem. And although it is more costly for banks, my point of view is it is more costly, but I think it would be much more costly should we not have the ring fencing, because the answer, in my view, from the regulators would be you should have even higher capital requirements. That's where I come at it. Yeah. And I agree with the comments, but I think it would be worse without the ring fencing, and we will see. Now, to your specific question, I think what's going to happen is very clear in terms of global recovery and resolution. I think we are now starting a global battle of where is the capital located internationally. And like the UK is now ring fencing the UK banks, the Americans are saying, oh, we run the risk of not having any capital here because the capital is all consolidated, but it's trapped, for example, in the UK. Therefore, we should create a holding company in the US, make sure that all US activities of the foreign banks are under that holding company, and we are going to ask, as you know, for local capital requirements in that holding company, which is a big issue for the global banks, especially the investment banks, and I think we run a big risk of balkanization of capital worldwide, and this is the present battle. Lloyds is going to be a very simple and boring retail ring-fenced bank in the UK, so we don't have that problem.
Well, that's my point. So that's why I think it's not, that's why I don't think it's tenable. So keep creating fragmentation of capital and fragmentation of liquidity pools, you will drive the system to a point where it cannot attract capital. And at the end of the day, if the system cannot attract capital, then you wind up not having banks. And therefore, I don't think it's tenable. I think the answer lies in what John said. The answer to good credit underwriting and good risk taking is not don't do the activity. It is how do you improve the credit underwriting and how do you improve the risk taking and how do you improve the supervision mechanisms to make sure the credit underwriting and risk taking is good and sound. I think that is the place to attack, not the notion that since we don't trust you can credit underwrite and risk take, we'll stop you from doing it altogether.
Agreed.
I mean, I think
Robert, please, can you you and John close the gap a little bit that's emerging here?
It's interesting when you look at the whole discussion around the ring fence, and a lot of the ring fence discussion started with a presumption that retail deposits were used to fund what the governor of the Bank of England likes to call the casino banking business. Now, it's interesting, within Barclays, we never, ever used the retail deposits to fund the investment bank. It was always totally separate. Wholesale funding was the way that the business was funded. And empirically, if you look at the failures in the UK, they tend to be very focused around some of the smaller retail banks and bad lending decisions. Would we have asked for a ring fence? Absolutely not. Do we support what Vickers is doing? Yes, because we think he's actually been quite thoughtful about what he's doing and how that moves into recovery and resolution. But the challenge, and I think there's a thread that runs through all of these discussions we're having, is there is no global agreement. So if you want a recovery and resolution plan, that's great if the FSA agrees it, but what if the US regulators don't agree it? And they can't even agree what they would do if it did happen in 10 years' time. And that's the big challenge, and it comes back to the same problem. How can investors invest in bank stocks until they understand what the regulatory framework really is? And they have clarity that it's agreed. And when you look at what's happened over the last few years, most of the regulatory directives were out of the way by 2009. Most things that have come through since then are politically driven, and they're domestically driven. And as we go through this process of lack of agreement, and God forbid we end up, as Antonio says, in the balkanization of banking, there's only one answer, and that's everyone goes home. Mm-hmm. Because no one will be able to afford the layer on layer on layer of capital and regulation to service their customers at a competitive rate.
Yeah. But John, did you want to comment on that? Because I want to go on to ring fencing, but have you got a resolution and recovery planning as a bee in your bonnet in the sense of, is it being overdone in terms of a potential risk mitigant for us, systemically?
No, it's because it's being done for the reason the other panelists said. There's a lack of trust between regulators. The evidence is that when things go wrong, it's each man for himself.
The regulators.
And therefore, each regulator is trying to protect his own patch.
Yep.
And that's incompatible with the structure of banks.
Yep.
And it either makes them very inefficient and costly to run, or it makes them non-viable. And the worry is it's non-viable, which goes back to my point again about strategy.
Absolutely.
Is there going to be imposed on banks a strategy that they can only be domestic?
Yeah.
Because that is one solution. It's not a very attractive one, but it's the simplest solution, which is you take deposits in this jurisdiction and you use them in this jurisdiction, and we'll keep an eye on you.
Exactly.
And we can control that because we have purview over it.
Exactly.
And if you want to have a group of shareholders that has a number of entities that do that, then that's next best. And then the worst, I guess, is the bank I used to work for was just a whole load of branches around the world, because we ran a very efficient model where everything was booked in London. All the risk was in London, but it was a Swiss company, so was the capital in Switzerland? Maybe it was. Where is the capital? It's not really on the left-hand side. There's no asset representing the capital. It's on the other side. But the assets were booked in London, legally, but the capital wasn't there, and they were being booked from all over around the world. The question is, if you're sitting in London and you're using that as a booking model, and many big banks do that, that's one of the reasons London has such a big banking sector, is that the FSA's light touch regulation a decade ago encouraged people to agree one model, one booking model with the FSA. You book everything there, you get offsets, you get concessions against the capital. You write everything with one entity. Clients love it because their counterparty is always one entity. They're not dealing with 25 different entities within the group, and so you're very functionally efficient, and it's the antithesis of what people want in a crisis.
But
well,
David,
Piyush, please.
Here's the issue. So if you foresee in the near future, you have large pools of savings in the West, you have tons of this thing, you have huge requirements for investment, let's say in Asia. A banking system which is domestically centric, and say you take savings in a country and intermediate that in the country, kills one of the fundamental abilities of the system to intermediate saving surpluses in one part of the world into deficits in another part of the world. So let's assume you create this banking system which doesn't play this role. So what's your next outcome? Do savings stay in pots or do savings still move? Savings still move. Yeah. What happens? Then you say, okay, we protected the banks will not intermediate the savings, somebody else should come in and intermediate the savings. Sure. So you wind up with quote-unquote shadow banking or other mechanisms to move these savings pools and get the kind of what you want the savings to do. Does that make the world a safer world? Does that create better financial system stability? I don't believe that's the case. I think we're kidding ourselves if we say, let's regulate this, we'll unregulate everything, the pools get bigger and bigger, and that's a safer macro environment. How can that be?
Yeah. By the way, please catch my eye as I look round if you want to ask a question to the panel or make a point.
Can I just make a point?
Please, yes, Antonio.
I think it's just to add on this point. I think they're going to regulate, obviously, shadow banking as well, so it will be coming. It will be coming to a theater near you. But it's very interesting when people say banks will not be investable. I fundamentally disagree with that. Because I have, for example, when I started Santander in Brazil 15 years ago, in Brazil, for example, the equity ratios were around 15%, and the Brazilian banks were the most profitable in the world. So if banks have to play and have to operate with higher capital ratios, which, by the way, in relation to any industrial company, are very small anyway, spreads will be a bit higher, banks will have to focus on costs, and returns can be incredibly high. So there is a period of adjustment, and I agree the period of adjustment is tough. But if you have the right strategy and the right model, you can perfectly have very high returns with high capital ratios, as you saw, for example, in the Brazilian example, or you had similar examples 30 years ago in Southern Europe.
Indeed, indeed. Well, then, we've had a conversation which is, I think we've all agreed that resolution and recovery planning is difficult. On ring fencing, we've had this debate now for 20 minutes, and nobody's mentioned the expression Glass-Steagall. Now, Antonio, I've got to come to you on this one, because you do seem to be an apostle of this particular desire in Vickers and not so much Volcker. We can talk about that in a moment. But do you want to see the return of Glass-Steagall?
Well, that's an interesting question as well, which I...
Yes or no would do, by the way.
No. Good. Which I answered in the select committee in the UK to the Archbishop of Canterbury. Asked exactly that question.
Wow.
And I told him, and I strongly believe this, that you should not force Glass-Steagall for two simple reasons. Very simple. First, because I think that from the customer's point of view, the customer likes an integrated approach. And so if the customer likes an integrated approach, I think the holding company owning the retail bank and the investment bank should coordinate and, through a single focal point, tackle the customer and provide him with an integrated solution. Okay. And second, because I do think that if the synergies from the customer point of view of an integrated approach are not value creative, the holding company will trade at a discount and the shareholders will ask themselves, the board, to split. Yeah. So I think you should leave it to the market. You should not impose it, because shareholders can do it themselves. And on the other hand, I strongly believe that customers prefer an integrated approach.
Yeah. Just before I ask the next obvious question, actually, are there any yeses to bring back Glass-Steagall for the rest of the even if you haven't spoken to the Archbishop of Canterbury about it? Good. That's excellent that we don't, because I think there are some people who still have a hankering for Glass-Steagall. Then what does it mean then? What does it mean then for, and let me put this to you, Piyush, first, if I may. I spent most of my life, partly at HSBC, but in German banking. And when I left Bankers Trust to go to Commerzbank, one of the things they said to me, and this is the early 70s, you will like German banking because we have the universal banking model. And they were the only people along with the Swiss who used that expression. And I got to understand it and know what it meant. And in fact, at HSBC, we sort of rebranded ourselves as a universal bank. Now, it's very clear that the Liikanen proposals, which are a sort of a cocktail between Volcker and Vickers, are not going to be adopted. But principally, out of actually Germany and other countries in Europe that like the universal banking model. If you ring fence, how are you going to keep the universal banking model alive other than by having a factory somewhere that produces things to put under or over the fence? Does it mean the end of the universal banking model if we ring fence?
Well, I guess consistent with my earlier views, I like the universal banking model. In fact, if you figure in Singapore, even our regulator has a universal banking model. The MAS is a single point regulator for everything, and securities or whatever, right? And I think the model works well for the regulator. I think it works well for a bank. I think it just puts a lot of onus on making sure that you're doing the fundamentals right, that your risk management is right. I think it also requires a lot of intrusive supervision. So I'm a big fan of that. I think over-reliance on a regulatory architecture, to the extent that you downplay the importance of supervision, can be risky. I think all of us complain a lot about the number of supervisors that come into the bank environment. I think that's not a bad thing. So, because that's the trade-off is getting into eliminating universal banking, creating ring fencing, and going down the regulatory path. I think the intrusive supervision path is a better way to deal with it. And I think a universal banking model is consistent with that.
Yeah. Robert?
I think universal banking as a term will last for quite a long time. But I think actually what constitutes and what's within a universal bank, and different banks will look very different to each other. So one of the challenges with the universal banking model is a lot of people talked about it as a justification for being a very large institution or in many businesses, or just trying to be all things to all people, which they really shouldn't have been. And they never really bought in, although they talked about it a lot, into the actual synergistic cost savings. And this comes back a little bit to what Antonio was talking about earlier on. You can't plan for banking. We're in the middle part, probably, of the restructuring of the banking industry on top-line growth. You have to have a strategic approach to your capital and your cost base. And I think that's where the directive is going to go. And as people have a universal banking model, they'll just look very different to each other. There won't be one size fits all for that type of thing. They may have their fingers in a number of pies, so to speak, but they won't be doing everything within each sector of that business.
Yeah. I wanted to change theme, John, but did you want to comment on that?
A couple of supplementary points on universal banking. I think if the breadth of the bank becomes so wide, I think some shareholders, institutional shareholders, do question why they're not allowed to own the constituent parts separately, and what real synergy is created. I think the bank assurance model in Europe is now somewhat discredited. I don't say that because Antonio's around. He's got a big insurance company in his portfolio. But I think questions have been asked about what the management team of a bank brings to an insurance company, or what the management team of an insurance company brings to a bank. And the old adage about not needing to own the autobahn to drive the car, I think is a reasonably good one. And if regulation is going to be such that they have to be kept so far apart, really do they belong under the same roof? So it depends how broadly you cast the definition of universal banking. I think that's an external factor. There's an internal one that I always think, for me, is quite challenging, and I don't think it's talked about very much, which is the clash of cultures. And I use culture, the word, quite broadly. But I think it is actually a difficult management challenge to have within your portfolio, as we did at my old shop, a commercial, retail and commercial bank with a set of pay scales that look like the civil service, and a US derivatives trading platform, which look very different. An asset manager, hedge fund manager within the group. And I think melding those different approaches to business, the different types of people you need, to populate those businesses actually does produce quite a difficult challenge internally.
Yeah.
And sometimes you've got to wear a number of hats. And I think sometimes managers should really ask themselves the question whether they are really adding value when the business types become so quite differentiated and distinct. And I think that internal challenge is not, it's really not debated because it's an internal thing, but I think it does make things difficult.
Yeah.
Yeah. I think they're all very good points. I think my only point is the market is the best determinant of whether there is effectiveness in that model or not.
Yeah.
If the management is not bringing value to bank assurance or vice versa, the conglomerate will trade at a discount. And the market will force you to do the right things to get coherence in your business strategy and focus around what you need to do, as opposed to trying to regulate it.
Yeah. Yeah. And that's the period of adjustment that you were talking about. Sorry, Antonio.
Yeah. But just to comment, I think, John, that's a very, very good point. And I think that is the second reason why ring fencing is important. Is because the cultural differences between a retail bank, as you said, and investment bank are massive. A retail bank should be organized like an army, where there is absolute commands. You have to seek absolute clear lines of authority, cost efficiency. There is no doubt when the army moves, everybody moves. The investment bank is exactly the opposite. It's a commando approach. People get together around an idea, around a task. They perform the task, they complete it, they split, they go to the next task. Whenever I managed banks for Santander in Portugal and Brazil, I have always separated the investment bank in a subsidiary, separated from the retail bank, because otherwise you want the retail bankers always want the bonuses of the investment bankers, and the investment bankers always want the fixed salaries of the retail bankers. So you have the worst of both worlds. So from a compensation point of view, a culture point of view, which is a very important problem, as you say, very seldom spoken about. I also think that culturally it's very important to split them. But from the customer's perspective, they have to coordinate and provide an integrated approach because the customer sees value in an integrated approach. That's why you should have the whole thing.
I think there's another point to that as well, is a point John picked up earlier on. Different cultures make very different risk management decisions at certain times.
Yeah.
And also what you find, and I obviously came from an investment banking background for most of my career and then been involved in some more retail and corporate banking over the last few years, is in retail and corporate, what I observed a lot more is a real portfolio approach and a real client-focused approach, rather than sometimes investment banking can end up as a transactional approach. And the risk management skills I find often, especially around credit, are much better in the corporate bank and in the retail bank.
Mm-hmm. Mm-hmm. I'd love the commando analogy, Antonio. I shall borrow that, if I may, from you and use it again. There is let's try and move from ring fencing deposits. The other part of this equation is Volcker. Now, Volcker, everybody in this room regarded the Volcker rule, or most people, I would imagine, as an attack on our business. Now, it came quite clearly from an interpretation by Volcker, which was different. But the moment you say, well, we're going to take trading away, there's wicked trading that you're doing, we're going to take it away, that doesn't just affect CDOs, CDO squareds. And now my question to you is really this. Without rehashing the ring fencing, can the Volcker rule be implemented? And is anybody outside the US ever likely to really try and implement the Volcker rule? Because I think that Vickers is not directed at that. I don't think Liikanen is directed at that. But the Volcker rule is quite, for every American banker here, it's a headache.
No, I know. I mean, it's a bit risky for me to go into this question because I am a boring retail banker. So the Volcker rule for Lloyds is quite irrelevant. But my thoughts, and I'm sure there'll be much more interesting comments from the table, are I fundamentally think that you should not forbid things. I think forbidding is not the best argument. So I think that what you should ensure is that you connect risk with capital requirements. And therefore, as long as the regulators consider, and I think they are right, that trading is quite risky, they should allocate a sufficient amount of capital to trading activities so that the risk-adjusted returns are appropriate and safety is ensured. Second, I can see, given the dangers of trading, that you should not have a too big amount of trading in a retail bank, so I would accept caps. But given that I think that market making and trading are very difficult to split, there should be a certain amount of trading activities allowed. I would understand caps. I would be fully in favor of higher capital requirements for those, but forbidding is probably not the route I would choose.
And can it be implemented at all, do you think? Can anybody seriously implement the Volcker rule?
It's very difficult to split. Well, there's a couple of things. Obviously, there are desks with institutions that are entirely proprietary. So clearly you can eradicate. Now, that's interesting. Yesterday, Mr. Tyree in London and his committee decided not to push for this in the UK because they said it was just too burdensome on the banks, which I think is the first time they haven't tried to implement something. But when you step back and look at, it's quite interesting. It's difficult to figure out right now what effect the impact of this potentially coming down the track actually is. If you look at equity volumes globally in this region last year, they were probably down 35% on what they were before. If you talk to a number of fund managers, they'll tell you 20% of that volume's never coming back because it was all driven by principal trading desks in these markets. That makes a big difference to the economics of a lot of these businesses that people are running in the region, whether it be equities or fixed income or those other businesses. So I think the direction they started going down made some sense, but as per usual, the drafting of the law has become so complicated. I'm not sure they're going to have to be able to fully implement everything they want. I do fundamentally believe, though, that over a period of time, a lot of the regulation that's emanating from the US will become more enshrined in policy. I think they're slower right now, whether it's Basel III or whatever, but I think they will play catch up on this.
Let me just change theme again. Again, something that I feel, and I think most of the people in this room would feel as well. Yes, of course, we had a dreadful banking crisis. Yes, of course, it was our fault. There may have been other causes, the ones I mentioned earlier on. Yes, of course, I think we're agreeing that capital and liquidity in some form, resolution, recovery, some very fundamental changes must take place. But could I ask you all if you think that, particularly bearing in mind Dodd-Frank and MiFID and EMIR, which you're spared in Singapore, I'm pleased to say, should this not be left to the market? Because this is about infrastructure. This is about transparency in a way that transparency is delivered by people competing. Why is it that out of the G20 in Pittsburgh, which said things should be cleared where appropriate, we now have this dreadful harness being put on us by the regulators in terms of swap execution facilities, organized trading facilities whenever we're told what they are, MTFs. This looks like regime change to a marketplace that can look after itself. Are global regulators too intrusive in terms of market infrastructure? Should they leave it alone entirely and concentrate on Basel, on resolution? Or is it something that they should be involved in, or should we leave it to the banks, the brokers, the platform providers?
Well, as a segue from what Robert just said, I think there are two areas of misunderstanding on the part of policymakers and regulators, mostly in the US, where for some reason, following the American crisis, securitization on the one hand and derivatives on the other have been somewhat demonized, and they've been blamed for some of the issues.
You've gone off suddenly.
I've gone off.
Oh, that's better.
And I think there's just a misunderstanding on the part of policyholders as to what derivatives are and what securitization is, and therefore what the infrastructure changes are needed to control it better. Now, it presupposes they were not under control in the first place. And I think it's actually a reflection of the lack of standing the industry currently has, unfortunately, that it hasn't been able to correct what in my view is almost manifest error on the part of these standard and policy setters. And I think it's actually debilitating the global economy at the moment. And I feel quite strongly that securitization should be reinstated. Regulated, of course, but reinstated as a valuable, if not essential part of the economy, and particularly of the US housing market. So I do feel the US housing market will not recover until they fix Fannie and Freddie, which they've clearly just chosen not to do, and until they reinvigorate the securitization markets. Likewise in Europe, I think, we get onto shadow banking. I've always been a proponent of CLOs. I tried partly to manage a CLO manager here. I think it's an excellent product. It's a good source of professional, institutional capital to back lending to companies that need credit. And I think when they're properly managed and they have peer regulation from the market, then they're perfectly good products. The infrastructure point, I think, is a means of addressing apparent weaknesses in the derivatives market in particular. And I think there's a concern that because information filed by banks was inadequate prior to the crisis on derivatives, and because the notional amounts of derivatives really are eye-watering, because there are a multiple of global GDP, a real multiple of global GDP. And my former bank had over $50 trillion worth of derivative notionals. And if you're out in measuring those by a very small amount, obviously your capital is at risk. But I think there are better ways of going about risk managing those positions and ensuring they're properly regulated than by centrally clearing them, because I'm not sure clearing has ever really been a problem in the derivatives market. I think the risks taken by the derivatives are potentially a problem, and people entered into credit positions using derivatives, just as they entered into funded credit positions, and they should be managed as risk positions. So I think there's been a misunderstanding as to the need to improve risk management in relation to derivative product that has somehow morphed itself into the need to clear them centrally. I suspect because if they're centrally cleared, there's a more automatic mechanism for reporting. But it doesn't improve risk management, in my view.
Is the invention of a CEF or an OTF actually going to solve that problem? Or is that a straitjacket for the marketplace?
Of a centrally cleared? Well, what central clearing does is it focuses clearing on one entity rather than a number of entities, obviously, which is not good from a risk perspective, and that's mitigated by the fact that you post valuable collateral, which means you've got to go off and get the valuable collateral, which means that you've got to buy US Treasury bills. That's helpful for the Americans because people who participate in the derivatives market now have to get hold of cash equivalent securities or post cash itself. And so that's created a new industry where people are swapping one form of collateral, one form of security which is not risk-free for one that's perceived to be risk-free. So there's another little business that's now growing very rapidly on the side in order to cater for central clearing. But the fundamental problem, I think, to go back to what I said at the start, is that people make losses because they make silly decisions in credit. And those credit decisions these days are more complex because they're embedded in products that are a little bit more complicated to understand. They're still really credit decisions. Mm-hmm. You lend money to somebody at a rate that is higher than the rate it costs you to fund that, and you hope you don't lose it. And that's what banking has been for a long period of time. The fact you dress it up in something a bit more complicated is by the by. But I go back to my point, which is risk management needs to be, is the function in the bank that needs to be properly regulated and improved, and better technology needs to be applied to it, and more common sense needs to be applied to it. And I think it was that barbell that was missing. The technology wasn't quite up to it, and there was no common sense applied very often. Mm-hmm. And people relied on models that were inadequate, and they shouldn't have relied on them. As long as you can solve that problem, then you can go back to where we were. It was clumsy, it was inelegant, and over time the market should have improved it as technology improved. But forcing everything onto central clearing, I don't think is the answer, because I don't think it takes away the risk.
I guess just a couple of, I agree actually with a lot of what John just said, but just a couple of other observations. One is there is quite clearly an extraterritorial element to a lot of the regulation, particularly Dodd-Frank, Walker, etc. The notion that if you're trading swaps between two currencies in a remote past of Asia, you still need to go and register with the SEC and provide global information to the SEC is a little bewildering, to be honest. The other element of it is transition arrangements. The reality is that in the short term, having to rely on central counterparties and multiple central counterparties will result in an increase in risk. So it will result in fragmentation, result in inability to net, and result in multiple collateral postings, and therefore a fundamental increase in the nature of risk till you can get to a stage where you either have bilateral or multilateral agreements between clearing agencies and so on. And I don't think we have thought through that.
Mm-hmm. Well, in that context, just a tangential question, technology. You mentioned earlier, actually, Piyush, the role of technology. Looking forward, and we've been talking about capital liquidity in the context very much of the massive technology that's going into building platforms to meet CEFs and OTFs. Technology is here to stay, presumably, but is it going to become even more important post the platform era, particularly if I'm thinking of retail banking, for example?
Well, I certainly believe that's the case. I think technology is going to be the ultimate game changer. And whether it's in the retail space or in the market space or the traded space, I think people loosely talk of big data, but essentially large data elements which can move fungibly and freely provide you better access to information, more real information, and the ability to take better risk decisions on the one side and manage things. I think it will fundamentally change, even in the next 10 years, our lifetime, not our children's lifetime, next 10 years. A lot of the issues we wrestle with are likely to be redundant. Right? And I think that's where the world will go. So to me, the big challenge in some ways is a challenge of transition. How do you get from a world that is today to a world that can deal with this in a lot more efficient form?
We've got a couple of minutes left, so do catch my eye, but I've got one more theme that I would like some views, and I think it's obviously one for John to start with, and that is shadow banking. Now, some say shadow banking is being forced ahead because of Vickers and Volcker and so on, and it's certainly true to say that some of the American banks and investment banks have evacuated the trading space to put the trading into what are effectively shadow banks. Now, what is going to be the role of the shadow banks? Some will compete, I presume, with banks. They won't be taking deposits, I guess. But is there a fear that shadow banks will be unregulated, non-regulated, or lightly regulated when the banks are getting actually more heavily regulated? Is the shadow banking world the threat that people like Mark Carney and Paul Tucker think it is? Robert?
Well, I think over a period, shadow banking has to be more regulated because it ends up as major counterparty exposure to the banks. And I think that's one of the key rules. So the ability of that industry to grow is undoubted at the moment. I think if you look at the investment banking universe for people, they would clearly like to work in a less regulated entity right now because they feel they're short an option to the regulators on everything. So that's very difficult. But history will tell you, and if you look at the returns of some of the parts of the shadow banking, it hasn't been particularly fantastic over the last 2 or 3 years. But their exposures to the banks, whether they be collateralized or not, and they are going to be large, and they have to be regulated for that reason.
Yeah. John, I can't resist asking your view on that.
Yes, you see, I've never been a big proponent of credit extension itself being regulated. I think banks as deposit takers need to be regulated when they extend credit. But I don't see why it should be the focus of regulators to protect professional institutional investors from investing in anything.
No. I wasn't advocating,
unless you want
by the
to
way.
dismantle the capitalist system, and then everything becomes either written in a set of rule books or it's not written at all. You're just not allowed to do it. But somebody somewhere surely should be able to take some real risk. And there should, of course, be regulation on the sale of investment product. But I don't think fixed income credit investors need to be protected against what they do, take credit risk.
Mm-hmm. Mm-hmm. did you want to comment on that?
I do agree with John, but I think they are going to regulate the institutions which will take retail money.
Yeah.
So when retail money will be taken, like money market funds, I think that will be regulated, as you already saw when you got the problem in the US of money market funds going below the buck. So I think that's where they're going to focus on regulate.
I am going to draw it to a close there. It's 2:30, I think, pretty well exactly. It is a huge topic which is close to everybody's hearts, and there's many questions to be posed yet before they're all answered. And we just scratched the surface today, but I think in a very, very meaningful way, if I may say so, and I really thank you all for that. Above all, you do know, if we don't know all of the answers, that the banking system is in very good hands with the people here that we have on the panel, and everybody has clearly got the message. But the calibration and the levers between capital, between liquidity, how you ring fence, how high it is, whether you do or not, there is so much yet to be decided. And we must remind ourselves, as I said at the beginning, it's been 5 years since Bear Stearns. We were in the post-Bear, pre-Lehman era 5 years ago when we were having this conference. And we still have some very fundamental issues to address. But address them, the panel has, and we've heard from major banks, local banks, an ex-banker who's not going to become a shadow banker, and I think I've learned a great deal, and I'm sure you have, and I'd like to ask you please to thank an absolutely tremendous panel discussion and a very honest and open one from people who really are in the hot seat. Thank you very much indeed, gentlemen.
Gentlemen, thank you very much. I guess there is still a lot of debate in the banking industry. We also know the successful recipe for Antonio now is to run the banks like a military. Don't go away just yet. We have some mementos from the ACI for you. If Daniel Coe will come back onto stage, please. And some gifts for our speakers today. First of all, to Robert Morris. We'd like to get you for a quick photo as well.
Thank you.
And to John Cryan. Piyush Gupta. Antonio Horta Osorio. And of course, David Clark. Thank you. Thank you very much. So now we're going to have the bankers leave this stage, and we're going to turn around and have the regulators come onto the stage. That's going to take us just a few minutes to switch microphones. Please, if you could remain within the room just for a quick stretch while we're changing. And I do have one quick housekeeping note for all of you. For those of you who are staying at the Marina Bay Sands, for tonight's dinner at Gardens by the Bay, please meet at the lobby of Tower 3 at 6:30 for a bus transfer over to the venue. And for those who are going directly, you should go to the Flower Dome by 7 p.m. And again, tonight's dinner, which is